12 o'clock, so I am going to go ahead and get started for us. My name is Ashley McVicker. I know my screen currently says Jill Franks. That's not me. I'm just on her computer, but I work with Farmers State Bank in the marketing department. We're really excited today to bring you this conversation about the Big Beautiful Bill Act. So today's session is focused on helping business owners understand the proposed One Big Beautiful Bill Act and what it could mean for planning in the months ahead. There's lots of conversation around how this bill may affect private and family-owned businesses, and our goal is to give you a clear, practical guide on how to be prepared and not overwhelmed. So today we are so proud to partner with Kemper CPA Group to bring you this exclusive briefing. Their team has been incredible resource to our customers, and we are grateful for their expertise. So we're especially grateful to have Robert Baird with us today. Robert specializes in helping business owners navigate tax changes and long-term planning strategies. He has a remarkable ability to break down complex information in a way that's easy to understand, which is exactly what this call is for today. So without further ado, Robert, I'm going to pass it over to you.
As stated, my name is Robbie Baird. I'm with Kemper CPA Group. Kind of a brief bio on me, but that's probably a lot more boring information than the One Big Beautiful Bill itself. As stated, I serve on Kemper's tax committee. We try to be a resource for employees of the firm and for clients and surrounding communities alike. So hopefully, what you gauge from today's message is informative. Again, it's kind of a high level exposure to what the One Big Beautiful Bill is. It's a means to hopefully ignite some of those questions, some of those thoughts, some of those instances where, hey, this is applicable to me. This is a discussion that I need to follow up on further with my CPA. A disclaimer, some housekeeping items. So again, the information in this webinar, it's as of today's date. It's what we know as of now, because as I like to joke, the IRS, they write in pencil. They don't write in permanent marker. Everything they do can be erased and rewrote to their benefit majority of the time. Before we get into kind of the important changes for the businesses, for individuals and everything, these slides, we're going to cover some of the main provisions that affect both those for tax years 2025 and in the coming years. Some of the components in the One Big Beautiful Bill will be new, while others will extend or make permanent some tax law changes that were placed in effect during Trump's first presidency with the enactment of the 2017 Tax Cuts and Jobs Act. The purpose of this presentation is to unpack some of the 1,116 pages that make up the One Big Beautiful Bill. It's a big bill, and it is a big deal because it affects every individual business with taxable income. Previously, I was asked, what is the biggest change resulting from the One Big Beautiful Bill? To which I responded, clarity. It gives us guidance to know which major components are permanent, such as the reduced tax rates, bonus depreciation on property and equipment, Section 179 expense, the 20% qualified business income deduction, estate and gift tax exemptions, and standard deductions, to name a few. So there's the disclaimer as I kind of finish my intro. But with this clarity, hopefully it will allow businesses and individuals alike to, again, have those informed decisions with the help of their CPAs, their advisors, so that they can kind of have those complex conversations. They can kind of cover the discussions that need to be had with their advisors. They can unpack some of what this language is and what these provisions benefits could be. So one of the first items that are affecting our business clients is the expansion of the tip tax credit. So under the old prior rules, the tip tax credit was predominantly only available to the restaurant industry. Under the One Big Beautiful Bill, this tip tax credit is extended to beauty services, industries such as concierge, gambling dealers, entertainers, home maintenance workers, to name a few. The IRS actually just recently released a whole list of what industries, what clients can qualify for this tip tax credit. The document itself, I think, is 17 pages long. It's a pretty niche list that breaks down kind of who qualifies and who doesn't. Again, I think this is something that your CPA will be able to advise you if it does qualify. Again, I think this is a long overdue change that aids to provide tax fairness to the employees in those industries. The credit is available to the employer to offset the employer's portion of FICA taxes. And since self-employed individuals are considered the employee and the employer, they too would be eligible. One of the largest anticipated changes is Section 168K bonus depreciation, or often referred to as accelerated depreciation. Under the old prior rules, bonus depreciation was set to phase out. As you can see on the screen, for 2025, it would have been at 40%. Under the One Big Beautiful Bill Act, bonus depreciation has permanently been set back to 100%. Note the effective date of this, January 20th of 2025. So for assets or property acquired and placed in service after that January 19th, 2025 date, 100% bonus depreciation is eligible if it is of the right type property. This transition election applies to the first tax year ending after January 19, 2025. So again, as we kind of go through some of these provisions, make note of these effective dates because some are effective for 2025 tax year where others aren't coming into play until the beginning of 2026. Another accelerated type of depreciation is Section 168N, which kind of piggybacks off of 168K, which is the bonus depreciation we covered on the previous side. The biggest difference between 168N and 168K is 168N is industry specific. Industries such as manufacturing, refining, production and extraction all qualify. While the 168K is also eligible and allowable to those entities, it's kind of an added step or an added incentive that if you're in that industry matrix, you can look to qualify under this 168N production property deduction to expend some items that otherwise would be 39-year property, HVAC units, items such as that. So again, kind of having those awareness as you're doing, whether it's capital improvements or leasehold improvements, some type of construction to the main real property itself, just having awareness to have those conversations with your advisor, it may save you some tax. The third type of depreciation change that we saw under the One Big Beautiful Bill is Section 179 expense. So Section 179 expense is where if bonus depreciation, where you in the past were only eligible to do 40% or under the new current rules, 100%, if maybe that doesn't make sense for where your taxable income is for the year, if too much depreciation could be a bad thing, you have options of electing out of that bonus depreciation and turning around and electing what is often called Section 179. So it's really a neat tool for business owners, for individuals, for CPAs to kind of control where we want taxable income to fall within any given year to make sure we're taking advantage of all those items that are, of significance, whether it's with the QBI, deductions for self-employed health insurance premiums, deductions for your standard deduction. You're fully wanting to take advantage of everything that the tax code gives you. And so it's great for us to see this 179 bill back in place. As you can see under the prior rules, the deduction amounts were at a much lower range. So starting in 2025, that 179 limit is up to $2,500,000 for assets placed in service. Note that there is a phase out range. So the annual investment limitation of $4 million is if a company purchases $4 million worth of assets, dollar for dollar, they will start to phase out of the ability to elect Section 179 if they continue to go over that. So if an industry or a company in particular purchased assets of $6,500,000, in that scenario, you would have fully phased out of your Section 179 expense and would be ineligible to take any of that depreciation. Effective date for this is January 1 of 25, so for all of 2025 tax year, and it is permanent. Another long overdue and welcome change is 1099 information returns. So I think it's pretty common knowledge that most people know if you make payments of $600 or more to any individual taxpayer or business other than your corporations, you're required to send them a 1099 for services performed of 600 or more. Under the One Big Beautiful Bill Act, this changes the amounts from the owed 600 threshold to a $2,000 threshold and will be subject to inflationary items going forward. Note the date of this change is January 1st of 2026. So for the 2025 tax year, the 1099 threshold does remain the same at 600. Section 163J, business interest expense. Adjusted taxable income will now add back the above expenses and restore the owed EBITDA, which is earnings before income tax deductions, which should result in allowing more business interest expense. Again, in my opinion, this was kind of a niche deduction that may have been limited or throttled due to how your taxable income was calculated. So under the prior rules, there was more limitations, more items that had to be kind of scrutinized on versus the One Big Beautiful Bill Act, where you're allowed to add back these items to taxable income, therefore creating a higher taxable income to interest expense ratio, therefore allowing more of your interest expense. So if you're a client or an entity that in the past has experienced that kind of reduction in allowed interest expense, hopefully going forward, you'll see these changes. This is effect for 2025 and permanent made going forward. Another big change was the Section 174 research and experimental expenditures, or often referred to as R&D or research and development expenditures. This change mostly affects industries such as tech and software development, pharmaceuticals, manufacturing, automotive, and our energy sectors. With the One Big Beautiful Bill, it retroactively reverts to the old ways of deducting these expenses, which were for our post-2021 tax years. As you can see, the prior rules from 22 to 24, you were required to capitalize and amortize those R&E expenses, which if anybody's familiar with that would kind of create a cash flow issue. Whereas under our One Big Beautiful Bill, those are now allowed to be expensed in the tax year again. No changes for the foreign research and development or research and experimental expenditures. This is just for domestic. This change is effective for 2025 and made permanent going forward. Section 170B, 1% corporate charitable deduction floor. Main thing to note on this slide is that this is for C Corps only. So under the prior rules, there was a ceiling on deductions, which was 10% of your taxable income. Under the One Big Beautiful Bill, we have that same, but there's also a deduction floor, not a ceiling. So it introduces this limitation. And so for an example, a corporation that has 100,000 of taxable income, it could only deduct donations in excess of $1,000. It's kind of created a minimum requirement, and anything in excess or over top of that would be a qualified charitable deduction on your C Corp return. Maybe one negative, in my opinion, from the One Big Beautiful Bill is some of the termination of tax credits or incentives for green energy adoption. So as of today's date, we've already seen some of those credits expire under Section 30D and 25E, which were the clean vehicle credits. The prior rules, you could receive up to a $7,500 tax credit for new vehicles and $4,000 for a tax credit for a previously owned electric vehicle. Under the One Big Beautiful Bill, that credit is eliminated for vehicles placed in service after September 30th of this year. So if before that date you had purchased an electric vehicle, hybrid vehicle, one of those vehicles that you think may qualify, it's definitely worthwhile mentioning to your CPA to see if there's some credit incentive there. But as of today's date, anything going forward, there are no credits available. Section 30C, alternative fuel vehicle refueling property. So this credit is for businesses that install qualified refueling stations. So if you're a restaurant or a gas station and you install a Tesla supercharger, there are tax credits that are eligible for some of the cost of those improvements. Note these credits are still in play. The property must be placed in service before June 30th of next year, because as of June 30th, 2026, that's when those credits expire. So again, if you're in that industry, you have a little bit more time if you're looking to complete something like that, but make note of that upcoming deadline. Continuation of the termination of tax credits. Section 179D, which is energy efficient commercial building improvements. Again, this kind of has that same deadline of that June 30th, 2026 date. This credit is for improvements to commercial property, such as installing LED lights, energy efficient HVAC systems, added insulation. Any of those costs are eligible to be turned into tax credits if a third-party energy audit is completed. Again, if you go through the proper steps and you go through all the policies that the IRS has implemented, then you could potentially be eligible to receive a credit in some of those situations. The biggest kind of kicker there is that third-party energy audit is required. And so upon the installation of some of those items I mentioned, you're looking to hire somebody that can come in and tell you, oh yes, you are now 20% more efficient in your energy bill due to LED lights throughout your commercial property. But again, as we all know, tax credits are better than tax expenses. So worthwhile. If you have any of those improvements going on, again, it's worthwhile in mentioning, but note your upcoming deadline of June 30th, 2026. Another large talking point that was kicked around at the beginning of the One Big Beautiful Bill was the qualified business income deduction, or often referred to as the QBI deduction. While there was discussion of a potential increase to 23% for the QBI deduction, it does remain the same at 20%, but with some highlights. Taxpayer phase-in limitations increased by $25,000 per taxpayer. So for a married filing joint, an increase of $50,000. Additionally, these amounts will now be subject to inflation as opposed to being the old static rules. So that's a welcome change. We definitely like when these numbers are placed in to a permanent status and have that inflationary item going forward. For that QBI deduction, again, with those phase out, phase in ranges and how you can kind of phase yourself back in through W-2 wages or the purchase of equipment or property, those are all detailed conversations to have with your CPA advisors, but again, a nice welcome change. I think that summarizes kind of the main changes for our business clients. Now getting into the important changes for the individuals that both whether you're just the average working individual that doesn't necessarily have their own business or they're employed by, there's a lot of changes in this bill that really can kind of benefit both alike. And so without further ado, one of the biggest items that I know was kind of a campaign promise that was ran on was the no tax on overtime. While that may sound misleading, the pertinent facts that we kind of want to walk away with are that this is a new rule. Under the One Big Beautiful Bill Act, individuals are allowed a deduction for qualified overtime up to $12,500. Spouses, if married filing joint, are not required to have overtime to take advantage. This is an above the line deduction, so it does reduce AGI. Only the half time qualifies, meaning if an employee is paid $20 an hour regular time and $30 for overtime, only the $10 will be considered for the deduction. It only affects Fed income tax. FICA is still subject, so your Social Security and Medicare are still required to be paid in. The most recent guidance that the IRS has given us that while the 2025 W-2s will not be required to disclose this overtime pay, the IRS is recommending that employers are able to possibly put that overtime wage in box 12 of the W-2s just as a complimentary service to their employee. Because again, as a tax advisor, I can only imagine fast forwarding to the time where we're trying to prepare people's tax returns and they're having to go back to their employers to have some type of breakdown of what was regular time versus overtime. So while the IRS has those rules in place for the 2026 year going forward, they've already revised the forms for that year. There is no requirement for the 2025 year, but I think at a minimum, the best transparency we can provide probably will be the better off for the employee, the employer, and the preparer. Another campaign promise was the no tax on tips. Again, this is an above the line deduction, so reduces AGI. A list of the occupations that may qualify, again, as I mentioned, was recently released. This goes back to all of those same tip tax credit occupations. You know, if you're a home maintenance worker, your barbers, your beauticians, your restaurant employees, everybody is now eligible to be considered some of their compensation in the form of tips. The $25,000 cap is not per taxpayer, so that is individual, married, filing joint, or separate. FICA tax is still subject. The 2026 W-2s, much like the overtime W-2s, will be modified with information shown in box 12 if applicable. Historically, for our restaurant clients or for the restaurant industry, there has always been a tip section on the W-2s. So none of that information really changes. More or less, it's going to be for some of those new specific industries that now can recognize some level of compensation in the form of tips. So again, look for further guidance on that as 2026 rolls around. I don't anticipate much for the 25 year as far as compliance or reporting, but definitely for purposes of taking that kind of deduction so that tips, again, won't be subject to income tax. A new rule that was not previously applicable under any other tax laws is the no tax on car loan interest. So an individual deduction for qualified passenger vehicle loan interest up to $10,000 will be available for tax years 2025 through 2028. So again, if you're in the market, the vehicle must be new. It must be for personal use only, meaning it's not a business vehicle. The vehicle must have its final assembly in the United States. The must be less than 14,000 pounds. You do or will be required to include the VIN number on the tax return. So again, that's probably just a more of a note of if you've purchased a vehicle for personal reasons, if you have interest paid on that vehicle, that's one of those worthwhile items to kind of stick in your tax folder and keep in front of you as you go to prepare to have these year-end conversations with your advisors or going into next year planning to get your documents ready. State and local tax law limits are often referred to as the SALT limits. So under the old prior rules, this deduction was capped at $10,000 for married filing joint, $5,000 for married filing separate, and $10,000 for single. So a welcome increase to those caps. Now under the One Big Beautiful Bill Act, we're looking at a $40,000 married filing joint, $40,000 single, and $20,000 for married filing separate. There are phase-out ranges, like most items, and the amounts will be adjusted annually for inflation. The permanent cap with these is temporary. So again, it's kind of that comment of permanent, but written within pencil. So these increased SALT limits are only for years 2025 through 2029. At January 1 of 2030, they will revert back to the old prior rules, which is that 10,000 and 5,000 threshold as you see on the left-hand column. Some welcome charitable contribution changes. So with the One Big Beautiful Bill, there's a new permanent charitable donation deduction for individuals that do not itemize. So up to 1,000 or 2,000 if married filing joint. And this is effective for donations starting next year in January 1 of 2026. It allows individuals who previously have not met the itemized threshold, which for 2025 is roughly about $31,000, to still get an added benefit of those charitable donations on their tax return. The new Section 170B charitable contribution deduction floor of 0.5%. So this is kind of similar to that corporate floor that we mentioned earlier, but this will be at the individual level. And this is for individuals that itemize their deductions. So same example, if you're an individual that has 100,000 of taxable income and historically you have itemized your deductions, well, your taxable income will reduce any of your charitable contributions floor by that 0.5%. The new Section 25F tax credit for contributions to scholarship granting organizations. So this is a new bill, again, a new law, something we haven't seen. There will be quite a bit of information that the IRS is still going to have to put out on this. The effective date is for years after December 31st of 2026. So again, I think that was on purpose to give the states some time to adopt this, to figure out how they're going to implement it, to allow schools, which again, this is just for your K through 12 grade students, for those schools to register with the states to figure out how they're going to take advantage of receiving some of these scholarship funds that individuals have paid into to receive these tax credits. So again, I think a neat credit that will be available to individuals, but a lot more information really has to be kind of given on that before we can dive into the weeds of it. So I've made the comment before, but another welcome kind of change or clarity, if you will, is the permanent increase to the standard deductions and permanent adoption of the current tax rates. So in the last 8 years, we have seen the reduced tax rates of a 10% through a 37%. That's kind of where our range of brackets currently are. We've had those for the last 8 years, and now under the solidification of the One Big Beautiful Bill, we will have those limits going forward. It also made permanent the standard deduction. It doesn't revert back to the old rule 9 years ago. So we're looking at that permanent increase of the 31,500 for the 2025 year, and that number is subject to inflation going forward. Enhanced deduction for seniors. So another one of the kind of campaign promises that was run on was no tax on Social Security. Well, while that was a nice comment, I don't think we ever really expected to see fruition to that. If anybody's familiar with how Social Security has come through the time of when initially it was not taxable at all, and then 25%, and then 50%, up to 85% where we are now, it was highly unlikely to see that go away. But what we do see is a temporary $6,000 per person increased deduction for people aged 65 and older by the end of the year. Again, this is a above the line deduction that will be eligible for seniors 65 and older for the 26, 27, and 28 tax year. So this is one of those temporary provisions that's in place. We'll welcome it for the 3 years that we have it, but after 2029, it will sunset. One of the large clarity pieces that in our realm, financial advisors realm, estate attorneys realm, that was highly anticipated is the permanent increase to the basic lifetime exclusion from 10 million to 15 million and adjusted for inflation annually. The amendment will apply to estates of decedents dying and gifts made after December 31st, 2025. So for 2025, the limit is 13.99 million, and starting next year, it will go to 15 million with inflation going forward. But again, this is one of those common talking points that individuals come to us and say, do I need to do any estate planning? Do I need to start gifting assets now? Do I need to start transitioning? At least this gives us clarity to know where that amount is, where we anticipate it to go, and knowing that 15 million is per person. So for a married filing joint couple, you're looking at a gross estate of 30 million before you really have to consider any heavy tax planning. Another piece that we're really expecting to see a lot of clarity on or waiting further guidance from the IRS is kind of for lack of a better term, the Trump accounts. So Section 530A creates Trump accounts that are tax advantaged custodial accounts for eligible children under the age of 18 who have a Social Security number. Unlike distributions from 529 accounts, there is no limit on how beneficiaries can use these funds. So that's kind of the unique incentive here. They're not like a Roth account either, where the child has to have earned income to contribute to them. So it's really a neat way to kickstart a young individual's retirement savings. Some families may be automatically enrolled if the IRS can create the accounts on the child's behalf. Again, further information is supposed to be supplied on that. Up to $5,000 per year can be contributed to these accounts. Employer contributions are even allowed, and they have a separate limit of $2,500. Contributions are not tax deductible. The money grows tax deferred, which means no tax on the earnings while it is in the account. Generally, withdrawals are permitted once the owner turns 18. Much like your other accounts, the language isn't in there yet, but we expect if those amounts are withdrawn before the age of 18 is attained, we would expect some level of penalty would more than likely be assessed. At this point, we're kind of recommending to maybe follow up with a financial advisor on this. I would think that they're probably a little more in tune with it than your CPA. So much like the businesses, individuals are also seeing a termination of the residential clean energy credits. Under the prior rules, there were non-refundable tax credits for clean energy costs such as windows, doors, insulation, exterior improvement items like that, residential projects, solar panels, wind, geothermal units. Under the One Big Beautiful Bill Act, those credits are all terminated as of the end of this year. So again, we've got a short window of time that if some of those credits or if some of those improvements need to be done to your home, you have a little bit of time to continue to do those before these credits are sunset and expired. There is no provision for them to come back. There isn't sunset. This is kind of a permanent reduction in those credits. And so ultimately, I believe that kind of covers some of the highlights of what are the key provisions in my understanding of these changes for business and individuals. So some people have asked, what stayed the same? Taxation of Social Security benefits. Again, it was mentioned that those weren't going to be taxed, but they are. But we do welcome that enhanced deduction for seniors. Corporate tax rates, they do remain the same at 21%. Inability to contribute to an HSA after Medicare enrollment. The PTET availability for pass-through entities. And so that is the election where pass-through entities are paying their partners or shareholders share of state income tax at the entity level. And in doing so, they receive a pass-through credit at the individual level. Again, that's a neat planning opportunity to kind of get a above the line deduction on your Fed income for any state taxes and escape those SALT cap limits if those are going to be subject. And another thing that stayed the same was our QBI deduction percentage. Instead of the 23% that was kind of mentioned during the drafting of the bill, once the final bill was signed, it did stay the same at 20%. So next steps, contact a Kemper representative or any of your other advisors, CPAs for some planning items. Look for potentials to amend returns to deduct those R&E or R&D expenses if applicable, if you're in some of those industry specifics. Consider capital expenses with 100% bonus depreciation or possibly utilizing Section 179 to help control that taxable income where you need it. Ensure payroll reporting is compliant with the new law. So again, no absolute requirements for the 2025 year. We will see revisions to those forms in 2026, but for now, IRS again is kind of suggesting provide as much clarity as you can. Improve deductions on your 1040 with the increased SALT cap. review estate plan considering the increased lifetime exclusion. So again, now that we know where we are and where that limit exemption will be going forward, it may ease some of those discussions you were waiting to have with your estate attorneys or your financial advisors, or those that you consider kind of close to helping you with that financial plan. I may turn it back over. At this point, contact information is on the screen. Again, if anybody has any questions, feel free to reach out to me directly. I'll try to assist best I can, or possibly point you in a direction that may better benefit you. I want to thank the bank for having me and asking me to host this. It's been a joy. I truly am passionate about tax planning. I do enjoy what I do, and so it kind of helps us to do that every day, day in and day out. And so when we think back and look at those things, again, it's not so much work for me, as well as helping hopefully those that are in our surrounding communities, achieve what they're trying to achieve with the less amount of taxes possible.
If you guys have any questions, like he said, you can email him at this address, or you can email marketing@myfsb.com, and we will get you in touch with the appropriate person. So thank you all for being here, and we will be in touch. Have a great rest of your day.
So Jill, where do we go from here?
Be sure to check out our show notes for this episode, and also be sure to follow us on social media and subscribe to our newsletter. And we'll see you next week.
See you next week.